The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Andy Duncan, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to this Gold Money Podcast with me, your host, Andy Duncan. Today, I'm privileged to be talking to Dr. Paul Craig Roberts, who, among many things, was a former Assistant Secretary responsible for economic policy at the US Treasury under President Ronald Reagan. He was also an Associate Editor at the Wall Street Journal, and he's currently Chairman of the Institute for Political Economy. Hello, Craig.
Hello, Andy.
On a recent King World News podcast, you painted this picture where the purchase of physical gold would be an obvious route out of a sky full of bubbles in bonds, banks and shares, but where you think the physical gold price is being manipulated downwards by all of the same people who are generating all of these bubbles. Do you think this is an ad hoc operation done in some kind of panic, or has it been a systematic, cold-blooded scheme that's been going on for decades? And how much longer do you think they can keep the price of gold suppressed?
Andy, I don't know how long it's been going on, but beginning early in April, it was obvious, I thought, that the Federal Reserve was involved and that the Federal Reserve was worried about the dollar's exchange value because the Fed has been creating 1,000 billion new dollars each year in order to support the Treasury debt issues and in order to keep the prices of debt-related derivatives on the large banks' books high. So by buying 1,000 billion dollars worth of Treasury bonds and mortgage-backed securities, the Federal Reserve has U.S. real interest rates in negative territory, which means high bond prices. That is their policy, their goal. But the unfortunate consequence is that the demand for the dollar is not growing by 1,000 billion each year. The use of the dollar as reserve currency is declining because other countries making agreements between themselves to conduct their foreign trade in their own currencies and avoid the fees of having to change, say, from yen into dollars in order to trade with China. And the Chinese have to do the same thing and trade their currency for dollars so that they can conduct their foreign trade transactions. And so they can avoid all these fees by using their own currencies. So we see that this movement away from the use of the dollar, we don't see the American economy growing to anything like the extent of needing 1,000 billion new dollars, or the world economy. And so the Fed was nervous that they would lose control of interest rates if the dollar took a big hit in foreign exchange markets. But of course, the dollar was taking a big hit in gold and silver prices. And so they decided, in my opinion, to dump massive amounts of shorts onto that market in order to create the appearance that gold is really not a safe refuge, that the dollar is the only safe refuge. So this was a Fed policy. Now, of course, they conduct it through the bullion banks, and the bullion banks, of course, can turn it to their own benefit, because if you dump huge numbers of shorts on a market suddenly, you're going to trigger stop-loss orders, you're going to trigger margin calls, and so the shorting will be profitable for you because it will cause all kinds of other sales. And you can then buy up those, in other words, sales of ETFs, these allegedly gold-backed ETFs, where people speculate. And so if the big bullion banks can get that market falling, it can then buy up those ETF shares and convert them into physical gold. And so it was a way for the big banks and a few of their very favored customers to loot the ETF's gold holdings and also make money on the shorts. And of course, it did cause in the United States apprehension about gold as a rising alternative to the dollar. So I believe that is what we've seen going on since early April. How long can they do it? I don't really know. It's odd to me, not being a gold trader, that the price of physical metal is set in a futures market in which the contracts exceed the gold available in those markets to back them up. You would think that the price of gold would be established in the physical market where people actually are taking possession of the metal, but it's not. It's established in the speculative market. So as long as that market exists, I would assume they can short it and continue this sort of attack on gold and silver prices.
Now, lots of people, perhaps east of Suez, have seen these short prices for gold or gold price dropping as being a great buying opportunity. So they've been soaking up lots of gold and saying thank you very much to the Western central banks like the Federal Reserve. Do you think that eventually maybe the Chinese could reach a point where the renminbi actually gets based upon gold and it actually replaces the US dollar as the world reserve currency?
I suppose it could. I don't necessarily think that they need to back their currency with gold. I think that what will happen to the dollar is just too many of them being created for too long when the world was already afloat in dollars. You see, it's been the reserve currency since Bretton Woods, and it's had no gold backing since, I think, 1971. So there's a tremendous amount of dollars in the world, and there's a tremendous amount of dollar-denominated financial instruments. I think all of these holdings that other countries have are viewed as excessive, given the rate at which the Federal Reserve is printing money. As for a need for a reserve currency, I'm not sure one is needed any longer. You see, after World War II, there weren't any economies. The developed world was destroyed in the war. And of course, China was being taken over by Mao and the communists, and the Russian situation was disastrous. So the United States had essentially the only economy. So it was natural for the dollar to become the world money. But today there are many economies, many developed economies, and these countries have currencies that are as sound, if not sounder than the dollar, and that they're learning that they can trade with one another in their own currencies and that they don't need a reserve currency. So whether or not the Chinese currency will become a reserve currency and whether or not it would be backed with gold, I can't say. But I think the dollar's time is approaching its end because there are just so many of them. But the American economy has been offshored, and the basis for the economy is just not here anymore. When you move offshore, such a large percentage of your manufacturing and such a large percentage of your tradable professional service jobs like software engineering, research, development, you don't really have an economy. By moving those jobs offshore, you're destroying the basis for the consumer economy because the people lose the good incomes. The jobs are moved. And so the U.S. economy doesn't face a good future, and the dollar is in excess supply. So I think that the dollar's time is coming to a close.
With all of these excess dollars that Mr. Bernanke's been printing in his kind of QE to infinity plans, James Turk's gold index has actually put the fair value of gold up at $12,000 an ounce. Do you think the Federal Reserve, as it's suppressing the price of gold, will actually allow a kind of managed decline where they'll kind of let the gold price creep up as it has over the last, say, 15 years? Or do you think they'll just keep whacking gold every time it gets to $1,900 and above, just to stop it hitting the magic $2,000 an ounce?
Yes, I think they don't want a rising gold price because of the threat to the dollar. You know, if the dollar is losing value the way it was relative to gold and silver, it raises the question of the dollar's value to other currencies that aren't being printed in enormous quantities. And so I think the Federal Reserve will continue, if it has the means, to attack the precious metal prices in the paper future market. You see, they're also protecting the dollar in other ways. They now have prevailed on Japan to print the yen. So apparently the Japanese are even going to outdo Bernanke in their printing scheme.
Which is quite something, isn't it?
It is. But you see, it's another large currency, which could have taken some of the traffic from people who want to get out of dollars. But if it's being printed too, then it's not really an alternative to the dollar. And of course, I think Washington keeps the pot stirred for the euro. They keep that sovereign debt crisis going that makes people uncertain about the euro. That's another large currency. But that uncertainty also takes pressure off the dollar. And of course, it may end up that the European Central Bank is going to have to print a lot of money as well in order to bail out the private banks that didn't do due diligence when they lent to the so-called pigs. If they can remove alternative large currencies and also keep gold and silver under pressure, they can continue to print money. I think that they have to do that because they're afraid of the solvency of the big banks. When they deregulate these banks and they let them buy up other banks, they got such large entities that they are disturbed about the failure of one of these entities. And to keep them solvent, they keep the bond prices high, because if interest rates are low on one investment, they're low for all. And in this way, they can keep the prices of the debt-related derivatives on the bank's books high. And so the banks look solvent or less insolvent. I think the Fed's idea is they need to keep this going for a long enough time for the banks to make money doing other things, that somehow their balance sheet evens out. But of course, the minute the Fed stops buying these bonds, the bond market is going to collapse. It's already a bubble. I mean, how can you have negative real interest rates when you're putting out $1,000 billion in new debt and in new money each year? It doesn't make any sense. And of course, the liquidity that the Fed pumps into the banks is not finding its way into the economy because the public is so indebted they can't borrow anymore. The banks won't lend to them. And so it's going into the stock market. So we have another bubble. We got a huge bubble in bonds, a huge bubble in stocks, and in my opinion, a big bubble in dollars, so that you've got three massive bubbles waiting to pop. And the minute the Fed stops what they call quantitative easing, the bond market and the stock market are going to pop.
I think that's the lesson of central planning, isn't it? Where central planners keep trying to do all these things, but the law of unintended consequences means eventually they lose control and these bubbles pop and everything goes horribly wrong. They have the British pound under control, they've got the euro under control, they've even got the Swiss franc under control and the yen under control, and they've attacked the precious metals to keep those under control. But eventually these things will pop and will go into what Doug Casey calls a Greater Depression, I think. If you were still at the US Treasury and President Obama came to you tomorrow and said, Dr. Paul Craig Roberts, I want you to give me a plan of action to get us back onto an even keel, what would you advise him to do right now?
Well, I haven't given this any thought because there's not any chance he's going to come ask me that. But clearly...
I'm just going to wave a magic wand and we'll pretend that he is.
The deregulation of the financial system on the mistaken belief that markets were self-regulating, this was a strategic error, unimaginable size, because out of that didn't come libertarian nirvana. We got crony capitalism. We got gangster capitalism. And when they get so big and they're so important to keep afloat, they become unaccountable. We have individual U.S. banks who have derivative exposure greater than world gross domestic product. This is nonsensical. It makes no sense whatsoever. Obviously, markets are not self-regulating. This came about because of the irresponsible, thoughtless, mindless financial deregulation. So I would tell him to get Glass-Steagall in place immediately, to put the position limits back on speculators immediately, to put controls back on debt leverage immediately. And if the banks have to go under, they just have to go under. You let them fail, you reorganize them. But it may be too late for that, because when you pursue a totally wrong-headed policy for so long, you really can't fix it without serious consequences. So even fixing it would have serious consequences. And as you've already said, not fixing it means it will eventually fix itself. And those consequences will be serious. So I think that what happened is they let economists with mathematical models run away with them. And they got this notion that financial markets don't need regulating, and so they would just take it away. And so then they got massive concentrations. In other words, the Antitrust Act has disappeared. We see it across all industries. It's just disappeared. There's no longer an Antitrust Act. This, of course, was always a foundation for the belief in competition. You had to have dispersed power, not a few concentrated centers of power. The only reason financial markets were trusted was that they were regulated. It's not really the markets that are regulated. It's the behavior of the people in the markets that has to be regulated. If you don't regulate them, you get what gave us the financial crisis. You get massive fraud, those mortgages, the securitized mortgages, the derivatives spun off of, all this was massive fraud. You get phony credit ratings assigned. But economic historians already knew this. This is what we've gone through before. This is the reason for the legislation in the 30s that established some sort of control over human behavior so that it would be have rational outcomes rather than gangster outcomes. I think once that happens, you just are going to end up paying a big price, and how it comes into effect, I don't really know, Andy.
One of the problems that we sometimes see with these kinds of crises is some people turn to warfare to mask the effect of what they've been doing with economies. Now, it seems to me that the US government is trying to surround Russia, and to do that, it needs to first of all take out Syria and then Iran to kind of get a lot of bases around Russia. Do you think that an Iranian war between the US and Iran might be a consequence of these unintended consequences?
Well, the United States government has been going to war and surrounding Russia, I think, even before they deregulated the financial system. So, all the agreements that President Reagan made with Gorbachev were broken. They started breaking them with George Herbert Walker Bush, the first Bush president, Reagan's vice president. I think when the Soviet Union collapsed, Washington just took advantage of that and threw all the agreements out the window. They've taken NATO. Reagan said that NATO would never go into Eastern Europe, but of course it did. We're now 21 years, I think it's been, or 22 years since the collapse of the Soviet Union, and we still have NATO. Well, why? Why do you have...
It's not defending the Atlantic anymore, is it, when it's in Afghanistan?
It's fighting America's wars in Libya or Afghanistan or wherever they start them next. And the missile bases that Washington tells Moscow are to protect Europe from Iranian missiles. I mean, Moscow knows that's a lie. So I think the hegemony that the United States is pursuing, the neoconservative policy of hegemony, is an ideological program that's independent of the financial and economic crisis. The financial crisis came from the deregulation and the belief that you don't need to regulate financial markets. And the economic crisis came from offshoring so much of the high productivity, high value added jobs of the American economy. Both of these crises are ongoing. If the financial crisis was not ongoing, the Federal Reserve would not need to be printing $1,000 billion a year. And nothing whatsoever is being done about the offshoring crisis. Most economists have assumed, erroneously, that offshoring of jobs is free trade, and therefore it must be beneficial. But of course, it has nothing whatsoever to do with free trade. It's the antithesis. It's the pursuit of absolute advantage, which in free trade theory is the antithesis of comparative advantage. That problem is not even acknowledged, much less addressed, though recently the Nobel economist Spence did publish a paper for the Council on Foreign Relations in which he took my position on offshoring. But that's the first sign that there was any awareness in the mainstream economics profession of this problem. So I think the wars are the ideology of neoconservatism. They're doing the same thing to China. They've announced, Washington announced that they're shifting the naval power to the Pacific. They're building new naval bases. They're getting back into Subic Bay in the Philippines. They're stationing troops, U.S. Marines, in Australia, and they're trying to get back the Air Force Base in Thailand. So they're really pushing to surround China as well. So the way I would look at your question is this. They're going to surround Russia, China, and Iran. And yet they don't have any resources except printing the reserve currency. If the dollar wasn't the reserve currency, if it collapses as reserve currency or is abandoned as reserve currency, the power of the United States is gone. It won't be able to print money to pay its bills, to surround massive countries like China and Russia. And it can't keep fleets in the Persian Gulf and also reallocate them to the Pacific to surround China. So I think on the whole, the overreach is massive. I think having negative real interest rates, this is a massive overreach. Trying to have this type of a military presence is a massive overreach. And allowing corporations to make short-term profits by substituting cheap foreign labor for American employment, this is an overreach. So when you look at these things, you see every sign of collapse is just waiting to happen. If you look at the United States, there's no sign of any strength anywhere. There are no jobs. As I have demonstrated for at least a decade, the economy has lost the ability to produce jobs that pay well. The only jobs that the U.S. economy can produce are low-income, domestic, non-tradable services. Most of the jobs are in waitresses, bartenders, hospital orderlies, and retail clerks. This is not the labor force of a superpower or of a developed country. It's the labor force of a third world country whose employment is in non-tradable domestic services. The United States has been like that for at least a decade. This is just not a picture of a country that is going to succeed, and certainly not going to continue being a reserve currency or calling shots in the world. It's overextended in every way.
I think this is the historical lesson of empire, isn't it? Because the same thing happened to the British Empire in the 1930s, where it was unable to pay some British sailors in gold, came off the gold standard, and then the British Empire collapsed slowly over the next 30 or 40 years. As well with the Roman Empire, when the Roman Empire overreached and started inflating, again it collapsed because of this kind of overreach. Talking about a bigger historical framework, you've just written a book called The Failure of Laissez, Faire, Capitalism and the Economic Dissolution of the West, which was published in February. America was a fantastic idea in which the feudalism of Europe was thrown off by American revolutionaries and in which Europe had to defeudalize in order to avoid losing all of its population to the Americas. So America was a fantastic idea and a fantastic practice for 200 years or so. Can you summarize from your book what made it go wrong? What was the kind of trigger or the series of triggers which made the American dream and the American lifestyle start to go wrong?
Well, I think it was the collapse of the Soviet Union. When the Soviet Union collapsed, we then had this ideology, the end of history, that there's no alternative to American democratic capitalism. This was the line. I think the Soviet collapse caused socialist India and communist China to reassess. And they did, and consequently, they opened their massive labor supplies to the West. And at the same time, Wall Street is putting pressure on every American corporation to increase its earnings, or we're going to sick takeover firms on you. And also, Congress legislated that you couldn't pay a CEO more than $1 million a year and have it a deductible business expense unless it was performance related. So all the incentives then was to replace American labor at $25 an hour with Chinese labor at 25 cents an hour. Jobs just began streaming out of the country. The big American corporations produce the goods and services they market to Americans in China and India. They produce these goods and services with foreign labor. And so this cuts Americans off from the incomes associated with the goods and services that they consume. So it's eroding the consumer economy. If you look at real retail sales, they're negative. They're not growing. If you look at real U.S. GDP and you properly deflate it and don't use the new trick measures that they're using so that they don't have to pay Social Security cost of living adjustments, the U.S. economy, the GDP has been negative since 2006. There's no recovery. The recovery is a product of an understated inflation deflator. I think that's what changed the outlook for the American economy. Many of what were powerful manufacturing cities are now in ruins. Detroit looks like some German city bombed out after World War II. These cities, like in the last decade, have lost a quarter or more of their population. So that is one aspect. The high-speed internet is another, because now intellectual work, software engineering, IT work, research, design, all these things can be done anywhere and sent in on the internet. We now have a situation where American college graduates, engineering, they can't get employment. There's no jobs. It's become really a crisis. It will end up causing people to abandon the universities because they're not getting a leg up from having a degree, even in engineering, particular fields like software. So that's kind of wiped it out. But at the same time, this victory over Soviet communism caused the economists in the United States and policymakers to think, wow, if we can beat them with regulated capitalism, just imagine how good we can do with unregulated capitalism. Regulated capitalism can defeat communism and socialism. Let's just take away all the barriers and let it run its full course and we'll do even better. Well, this was the mistake that led to all the deregulation. And that, when I say the failure of laissez-faire capitalism, that's what I mean. Obviously, we don't have it now, but we've had 25 years of deregulation here in the UK, in France. I mean, I was central in the French deregulation. That's why they gave me the Legion of Honor and privatization. Libertarians forget that we've had a quarter century of strong deregulation. The result is not what we thought it would be, me included. The result is crony capitalism, gangsterism, fraud, financial crisis, the collapse of capitalism, because, capitalism, its justification is it eliminates the ineffectual firms. And so it means that resources are always best used because the firms that are using them badly go out of business and the resources find their way to the firms that are better custodians of them and produce more consumer satisfaction. But you can't do that when you're having to bail out the banks. You can't let them fail. So capitalism no longer works. And the other justification of capitalism is that profits are a sign of consumer welfare. If you have profits, it means the resources met consumers' needs and were well used. But when the profits are due to the fact that you've laid off your own workforce and have hired Chinese and Indians, the connection is no longer there. What's happened in 20 years is we've destroyed both of the arguments for capitalism, and it's failing. Again, it's overreach. It was a mistake to say, oh, well, we beat them at half throttle. Now let's completely free the system and we'll do twice as good. Well, that's not what happened.
You paint a fairly bleak picture there. President Obama's probably not going to call you in the morning. So if we get down to, say, the average Gold Money podcast listener, do you have any advice to help them get through this bleak picture before hopefully things turn around in the future?
Well, where is a refuge? For a while, it was the Swiss franc, but what did the Swiss discover? They discovered that all the dollars and euros pouring into the franc was driving the value of it so high they couldn't sell. Their exports were threatened. So they had to announce, if the whole world's inflating, we got to inflate too. Otherwise, our currency gets driven so high that we have to close down the economy. So the only refuge appears to be the precious metals. But it remains to be seen whether Washington is able to tie the world up and keep them using the dollar and everybody inflate together. Now, the thing about these inflations, the money is not finding its way into the economy. And so the kind of hyperinflation that you would expect has not happened. We've had asset inflation. First, it was real estate prices. Now it's bond prices and stock prices. This is asset inflation. How long can that go on? I don't know. It's gone on longer than I thought possible. I don't know what kind of deals can be made to keep this afloat or for how long. But the only historical evidence that we have is that gold and silver tend to keep the value.
So do you think we should perhaps follow the advice of, in the words of Max Kaiser, backing up our truck and soaking up all of this cheap gold until eventually the Federal Reserve just cannot hold the tiger in any longer?
I think that that's what's going to happen. On the other hand, there are signs that we have tried to prevail on the Indian government to put barriers to the importation of gold into India. And the Indian government, to some extent, gets sold the economist line that gold is really not an investment, and all that money that's going into gold really should be going into your factories and capital equipment and human capital, and you shouldn't be letting the people put the purchasing power into gold. It just sits there and doesn't produce jobs and exports and so on. So I don't know whether they'll have luck getting the Indian demand for gold contained, or if they do, whether smugglers would be able to overwhelm it. And I have no idea what Chinese will decide to do or what kind of deals they might strike. If they're worried about being surrounded by American air bases and naval bases, they may make some agreement to help keep the dollar afloat as well. These things are not predictable, but certainly alchemy has never come into being, so they can't print gold and silver. And so I can't see how anybody can be hurt seeing it at least as an insurance policy. It's a way of protecting some part of wealth. And I suspect that that's what people will do. This whole process may last longer than seems possible. A lot of people don't know whether the Federal Reserve has the gold it says it has. The people are puzzled because when Germany requested its gold, Washington, that was last year or a few months ago, and Washington said, well, look, we'll give you some of it over the next 7 years. Well, why would you say that if you had the gold? It doesn't make a whole lot of sense. So whether or not the speculations over the last few decades that the Federal Reserve had let out its gold to bullion dealers who sold it in order to keep the price of gold from rising so fast, whether or not the gold is gone, and so now the Fed has to engage in shorts in the paper market, most of which seems to clear on a cash basis. And of course, the Fed can always print the cash. These things we don't know. They're not going to tell us. We get circumstantial evidence. They, for some reason, don't want anybody to go into Fort Knox to see if the gold is there. When you run into a situation where they say they have evidence and won't show it, it makes you wonder.
One wonders if they remade Die Hard 2 and Germans went into the Federal Reserve building in New York and looked for gold, how much gold would actually be there. There might be some Swiss contractors out there dealing with people in Dubai or dealing with people in Mumbai who might see Indian gold restrictions as a challenge rather than a complete barrier. It's been fascinating talking to you today, Dr. Paul Craig Roberts. How can our listeners find out more about your work and your other books?
Well, I have a website now. I finally got pressured into it. I didn't want to do it. It's too much work. It is simply www.paulcraigroberts.org. And I post 2 or 3 columns a week, and there's some archives. They're not complete by any means, but there's some archives there going back some few years, and the books are listed there. The latest is the one you said, The Failure of Laissez, Faire, Capitalism. This isn't written as a pro-government book. I was Reagan's assistant treasury secretary. I was a distinguished scholar at the Cato Institute, the big libertarian think tank in Washington. And as I said, I helped the French government in the 80s privatize industry. So I was all in favor of that sort of free market notion, but it overlooks human nature. It's an idealistic model that doesn't really capture the way people behave when they have those choices. If there's no regulation on their behavior and essentially nothing is illegal, then crime takes over. That book is available as an ebook. It's also available in print. It's also available in the German language, and it's coming out in the Chinese language, and I believe it's going to be a Russian language.
Crikey, a lot of languages.
And what it does, it shows the failures of economic theory, not just the ones we've talked about, but sort of a general approach. It shows the successes, where the successes are. It shows where the failures are. And it shows that policies based on those failures have to fail as well. So if you have a failed theory and you're making policy on that basis, then you're headed down the tubes. It also shows that a lot of economics, or actually most of it, is empty world economics. It grew up at a time when nature's resources were abundant relative to man-made capital. And so that's where a lot of theory originated. But today you have a full world in which man-made capital is very abundant and nature's capital is running out, particularly the sinks for disposal of waste. And the GDP accounts, of course, don't price the external costs, and they don't price the value of nature's resources, except the extraction cost. So we've entered into an era where we don't really know if the output is economic. It may be uneconomic because the cost of nature's capital is not in it, and all the external costs or social costs of production are not in it. For example, take something like fracking in the United States. They now claim, we have 100 years of oil and gas, and all we have to do is pump millions of gallons of water laced with all kinds of chemicals under high pressure into the ground and crack the rocks, and this stuff rises up. Well, what it does, it pollutes all the aquifers, all the surface water. They're going to end up destroying the water resources of the country. And then where are you? I mean, see, you're worse off. So all of these things are not in the cost of fracking. They just say, oh, look, we've got valuable oil and gas. Well, what was the cost of getting it? You destroyed this aquifer, this river. Those things are not measured. And so we don't really know whether economic growth is economic. It may be uneconomic. And the accounting systems aren't adjusted to the nature of the world. You know, there was a time when fish in the ocean were plentiful and fishing boats were not. Well, today it's the other way around. There's plenty of fishing boats, but fish in the ocean are going away. So those kinds of adjustments, economists haven't got their mind around it. And one of the reasons, and we're going on maybe too long, but this is important. The production function that economic theory uses is the Solow-Stiglitz production function. And it assumes that man-made capital is a perfect substitute for nature's capital. This is an absurdity, but that's the assumption. So what that means is there are no natural resource limits to growth. But how do you have infinite growth in a finite system? The resources aren't infinite. And so just looking at the production function itself, you can see economic theory is just completely wrong. It makes no sense. It's a contradiction in terms. Man-made capital is not a substitute for nature's capital. They're complements. They're not substitutes. And so you can't make the assumptions that are made, and yet they continue to make them. Well, these are the kind of things the book goes into, and it does it in a readable way. You don't have to be a Nobel laureate to be able to read the book.
Well, I can tell our listeners that the website does have some fantastic and fascinating articles on it on a regular basis. Thank you very much for your time today, Dr. Paul Craig Roberts.
I enjoyed talking to you, Andy, and I appreciate your interest.
Subscribe to the Gold Money newsletter at www.goldmoney.com. to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.